This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis and check to see if, largely speaking, things are still going according to plan. We're still in this kind of weird situation where the government's been shut down, they won't give us the data, which makes it kind of hard to update, but I've got a few little bits to touch on, so we'll go over those. First of all, starting off with the stocks, the base case was at the lows, everyone was too bearish, we'd have a blow off top to all-time highs and then come tumbling down in a global recession, and for a short period, we would slip into asset price deflation. Fast forward to today, and it largely speaking looks like we are well and truly on our way to that final blow off top moment. I've been making the case for a while now that this tariff tantrum back in April, or the April low, right, the start of January this year, was akin to this bear trap here, and by now we've got to be either at FOMO or approaching FOMO for the stock market. I think we're somewhere in this neighborhood, and if we go back to this chart, you know, there's the top, right, there's the tariff tantrum, the bear trap. We've got to be right around FOMO by now, okay, with just the last little bit to go. That's my expectation, and so it can break down at any point, but my expectation is it's going to continue to push just for a little while longer. I've been saying for a while before Christmas is kind of my expectation, but if it spills into Q1 of next year, who am I to argue with that, right? It's not really a game of I told you so's or calling the exact month. It's more a game of staying long and strong until it becomes unreasonable to do so. And when this thing eventually breaks down, especially once it's confirmed with some of the confirmation signals I'll show you towards the end, then I've been making the case it will be time to finally have that global bear market and recession. So for stocks, I say so far so good, okay, well and truly in a blow off top. It's probably going to go a little bit higher, hence me still being positioned long. I'll show you the positions at the end as always, and I'm just going to continue to tick this one off and take it day by day and week by week. For Bitcoin, the idea was pretty simple. Bitcoin, whilst it's in the bull phase of its 4-year cycle, chains together a bunch of weekly cycles which make up that 4-year cycle. Out of every one of these weekly cycles so far, we have seen, approximately speaking, a double off of the low. One of the members recently pointed out if you average the gains for the first few, you get 94 or 95%, something like that. And then if you average 120 and the most recent one, which fell short at just about 70%, you again get around 94%. So I wonder if what's coming out of this current weekly cycle low is a 94% pump. Now I know as I say this, okay, sentiment has been becoming more and more negative for some time now. And I think given the current price action, I can see just based on comments and on Twitter that sentiment is completely destroyed here. And to that, I simply say good. Now, we've got to address the first issue with this idea, and that is that whilst I was calling for another double, approximately speaking, off of the lows, this prior weekly cycle actually fell short by about 30%, which means we left everything to the left-hand side of my cursor untouched, and we squished down the right-hand side. I'll show you the difference. Here's the original one, and here is the squished down version. But as you can see, it is now time to sit up and pay attention, okay? We are now in a very similar situation that we were back here. Back here, sentiment was destroyed, and I kept saying, nope, there's no trendline break, there's no move above the 10-period SMA. There is no DSS Brexit cross, okay? Like there was back here. It took a while to show up, and currently there is no DSS Brexit across here either, and there is no swing low pattern, okay, up until here, and currently at the hard right edge we do not have the swing low pattern. So therefore, it is malpractice to say that the weekly cycle low is in or it has failed, okay? We are yet to see a weekly cycle. It's taking its time, just like it took its time at the last one, but the last one did resolve to approximately a 70% pump, okay? So if we can get approximately a 70% pump here, just like the prior one, which of course was significantly less than all the prior ones, that still puts about 170k on the table, there or thereabouts. And if we can get 94%, it puts us closer to 200k. And again, I'm sure as I'm saying this, people are already in my comment section typing, oh, this is ludicrous, you can't call for this, it's bullish, it's over, it's topped. And by all means, sell, go short. It's not for me to tell you what's happening here with any degree of certainty. This is a market. It's an inherently uncertain environment. But what I am going to tell you is I'm going to do exactly what I always do, which is wait for the confirmation of the weekly cycle, put some trades structured around that weekly cycle, and then see what the market will give. So this is not my first rodeo, okay? And it won't be the last. I will say this, because of how late we are in the 4-year cycle, just being 2 weekly cycle lows away, okay? The second one now that will form is actually expected to be the 4-year cycle low as well. It is expected that we get left translation in this current weekly cycle. So once it confirms, that means we get a top to the left-hand side of the midpoint of this cycle, which simply means we measure the gap between this blue arrow and this blue arrow. We draw a line through the middle of it, okay? And that means that wherever the high for this current weekly cycle, once it confirms, ends up being, it should be to the left-hand side of the midpoint. And that will essentially just confirm that we are now going to spend the majority of the time declining into that 4-year cycle low. So largely speaking, this is still going according to expectations, okay? And if we can just get about a 94% pump out of here, then again, we'll be able to look back here. And whilst sentiment is completely destroyed, whilst many people, like I said, already in my comment section type in this is ludicrous, ludicrous and insane and it's never going to happen and whatever, okay, if it does do a 94% pump out of this in the coming 8 or 9 weeks, and once it's confirmed, remember, left translation is about 3 months from that low confirming, okay? So we have actually got a full 3 months here to do a 94% rally. And as I said, if it does do that, then no one will be able to say with any credibility we couldn't have seen that coming, okay? Because that is exactly what every other weekly cycle has yielded. Could this time be different? Sure, because we are much later in the cycle now, and thus confidence decreases the later we go through the 4-year cycle. But even in the bearish scenario, we should get some relief here to let us out higher up than we are currently. Okay, so that's my strategy. That has been my strategy. That has not changed. And anyone that's been here any length of time has seen me do this for every other weekly cycle. So for the Camel Crew, this really is business as usual. I expect to be positioned by the crypto stocks mostly, again, out of this, just like I was for the prior two, as they give me a higher beta return. And frankly, they look like they have declined significantly more at the moment than Bitcoin. So I think this is a massive buy-in opportunity. Again, I could be wrong, but that's what risk management and stop losses are for. But right now, I fancy my chances just based on sentiment, okay? The technical setup is there, and the worse sentiment gets into the weekly cycle, the higher degree of confidence I have in successful trades out of those weekly cycles. So I'm going to keep doing me, okay? And by all means, if you think it's topped or you think this is crazy, you can just go short. That's what makes a market. Now, as I said at the start, if we're going to have a global recession and a short period of asset price deflation, then we would need to see this disinflationary trend continue since our inflation top call. And that brings us on to the next part of this base case hypothesis, which is that we are going to slip into deflation for a short period, a couple of months perhaps, and this disinflationary trend is far from being over just yet. Simply because anything you do to the M2 rate of change shows up here in the CPI with a lag. And when we take a look at an updated version of this chart, you can see right here, okay, it's still very much in a disinflationary trend. Investors are, as often is the case, still very quick to look at this and be slaves to the tape and draw false conclusions like inflation is sticky and all this kind of stuff. But the reality is where it matters, rate of change down the bottom, okay, this is not anywhere close to being bottomed or turning back up yet. Now, as is on theme for the government at the moment, okay, apparently we're not going to be getting any more inflation data, not anytime soon at least. And it's kind of interesting because at the same time, the nowcast has just shown inflation here fall off a cliff in October. So I still make the case this is suspicious timing here. And we also know that whilst the CPI metric is largely propped up by shelter, which is a massive lagging component, when we substitute for a real-time metric like ALNRI, we've been deflationary for over a year and a half. Okay, so how much longer can this lag not show up in the data set? The answer is, I think we've pretty much exhausted the amount of time, and that's why they don't want to release the data now, because they don't want to scare the market into realizing that deflation is actually the risk here, which of course will highlight Fed policy has been overly restrictive and the Fed has been behind the curve. Here's CPI year over year with ALNRI instead of the shelter component, okay? Headline and core both well below 2%, okay? So the whole idea that inflation is sticky or is ticking back up or any of this kind of thing is actually a psyop, and investors just have bought into that psyop way harder than I was anticipating. And so we're going to continue to take that off and say until such time as we reach invalidation, okay, then we're going to continue to expect this inflation to continue and ultimately reach a short period of asset price deflation, probably by about the middle of next year. Now, at the same time, the next part of this component, of course, is if we are going to have that global recession and bear market next year, then of course we would expect to see labor market deterioration. And we continue to see more and more ADP misses. We had even more ADP reports showing losses for October now. Okay, so it's not a good look. And at the same time, this is also occurring, remember, with a government that has been shut down and is now refusing to release this data. It is also said that it's likely permanently lost a chunk of this data. Okay, so again, I smell a rat. Again, I suggest to you that this is some big psyop and they have not done this through sheer incompetence, but instead this is done with malice. And I still make the case that when the NBER goes back and officially dates the recession, they're going to do so from about Q3 of this year, because that's what the labour market has been telling us, right? The labour market has consistently been significantly worse than they've been letting on, for the simple reason that even though it showed a clear trend towards deterioration the whole time we've been doing this, they then continue to revise down by record numbers. And of course, all of this right before they then go and start losing the data permanently, right as we get to the critical inflection point where it's going to start to become obvious to the masses that we likely have already started to head into recession. I will also add here that this is at a time when we're getting many of these record announcements of layoffs, challenging levels not seen since the GFC. Okay, so again, I make the case, this is not nothing. We've been expecting labour market deterioration, and we've gotten all the way to essentially the part where now nobody can argue with it anymore, and then they've started to lose the data. Now again, You don't have to accept this. That's what makes a market. Okay, I'm just presenting the data as I see it. And the markets are not the economy. So I'm still remaining long biased and bullish into the end of the year because the markets are not the economy. But the economy is rolling over. And to say it's not, I think is malpractice. We can also see this in the leading indicators like the JOLTS, construction quits, okay, at levels not seen since the GFC. When we take a look at the unemployment rate for the US, again, it hasn't been updated in a while, but look how suspect this is, at least to me, right? Notice how in every shaded area of recession, okay, we get these big spikes in the unemployment rate. And at the hard right edge, we've curled up, gotten right to the point where it looks set to explode to the upside, and they just so happen to lock down the government and lose the data. Now, maybe I'm too paranoid. I often say that it could certainly be the case. But I also, again, make the case that I'm probably right about this and they probably know exactly what they're doing. I don't think it's coincidence personally. We can see an even clearer trend here in the unemployment rate for 16 to 24-year-olds. Okay, it looks like it's just getting ready to spike and go recessionary. Okay, and then they're not going to produce the data anymore. And then it's the same deal for U6. Okay, showing very lead-in type of looks. Lead-ins, of course, precede explosions and the explosions synonymous with recession. So I'm going to continue to make the case. We are probably already in recession. The labour market deterioration is probably continuing to be a lot worse than they let on. And all of that is going to continue until eventually the rest of the market works out that we are indeed heading for a recession with continued labour market deterioration. And so at the moment, it looks like the bond market is currently unsure of how to price the rates. We are currently looking at 55% probability that we are going to be remaining paused in December's FOMC. Now, I am here to suggest that this is because the yields are currently staging a counter-trend rally, which will soon resolve to the downside. And as it does, we will then reprice this back this way, since this is calculated based on the bond futures, and the bond market in aggregate is what determines rates, which is why we often say on this channel, tell that to the bond market. But right now, this is seemingly reflective of a bond market that is trying to decide whether or not it smells a rat as well, or whether it can just say, well, the government lost all the data and we can't really make a decision because we don't have the data. But if I pull up the US 10-year yield, the chart of truth right here, okay, you can see we have gotten that first repair. We were talking about perhaps even getting a push up here, something like this of late, which sets up the TLT trade before then reversing and moving sharply lower in line with the tell that to the bond market squiggle, which remember started here, okay, then we shoved it over to here, and once we get to resistance, we'll probably shove it over once more and do something like this, okay, or I guess we just leave it like this. But this counter trend rally in the yields is what is causing the bond market to be unsure about rates, okay? But remember, once it hits resistance and rolls to the downside, then that is the bond market in aggregate determining where the rates should be, and of course that will be conducive to moving this in this direction. And of course, all of that will make perfect sense because we've got significant labour market deterioration, which is way worse than they're letting on, and the Fed is significantly behind the inflationary curve. So I'm going to take all of this off at this point and say things are still going according to plan. Nothing seems to be out of the expectation, and nothing seems to be even close to being invalidated so far. And so since all of that's true, context is key, okay? Because whilst investors in aggregate think cutting rates is bullish, that is only true when we're cutting into normalization, which is the inflation returning back to target and baseline whilst maintaining a soft landing, okay? And I am continuing to make the case that we do not have a soft landing here, and these are in fact cuts into a recession for a number of reasons. The ones already stated, okay? The Fed behind the inflation curve, the labour market deterioration, but also, as you'll see in a moment, okay, we've got yield curve inversions, and that never happens when we are cutting rates into normalization and a soft landing. Whenever we get a yield curve inversion, it has always been synonymous with cutting into recessions. And of course, by the time we get to the December's cut, assuming they do cut in December, which I think they probably will, okay, we're going to be in this 3-month window where historically bad things happen on average for the average and the median stock market returns walking forward. So I do very much make the case that we are still going to continue to push higher into the end of the year. I expect to be largely cash by the time we get there. I'm already significantly in cash. We've been taking a lot of profit in the level 3 members section. And I continue to expect that cash pile to build and build as we get towards Christmas. And I do continue to expect this market to move higher before eventually breaking to the downside. And when it does break to the downside, I will be looking for confirmation that that really is the top in a couple of places. First of all, we'll be looking for the high yield credit spreads to start to break out to the upside, which is synonymous with financially stressed conditions, okay? And I'll also be looking for an accelerative sweep to come upon a reverted yield curve inversion, okay? So remember, the nuance with this is when it inverts, everyone screams recession and they're wrong, and they do the same when it reverts back above zero. But the nuance is it's the accelerative sweep to the upside on the weekly time frame that is synonymous with actually seeing the tops coming in. This yield curve has been record inverted for a record amount of time and has since now reverted. And again, it left a lot of people to misread this, but it is the accelerative sweep to the upside that is synonymous with confirming that trendline breakdown in the stock market is for real. And so if we take another look at this chart here, you can see the accelerative sweeps, okay, mark the dot-com bubble burst, the GFC and the C19 plunge, okay, kicks off with this accelerative sweep in the 10-2 yield curve. And right now we've just been climbing forward and trading sideways since April. Okay, since the tariff lows. So all the while we trade side, there is no alarm signal here and no financially stressed conditions. Okay, all the while this thing maybe rolls over again. Okay, we can continue to say this bull market has legs, it's going to continue to run, perhaps spill into next year, and we can stay long and strong for a while longer. But the moment we get breakdowns in the stock market and this thing starts to sweep to the upside, like this sweep back here and all the prior ones I showed you, that for me will be a real tell that we have topped for the 4-year cycle for the stock market, and we will be heading down for that 4-year cycle low late 2026. Now here's where things get interesting, because if we sharpen this 10-2 yield curve to the 10-year 3-month, okay, then this historically gives a signal that gives you even less time to react. Okay, by the time this thing pops, like it did in these prior incidences, the top was already in the majority of cases. And as we zoom in here, you can see we are now closing for a third week, a weekly candle above the breakout line here. Now, the reason I've drawn this red line across the top is all the while we range in here, okay, then that's a range and there's no alarm signal. But the moment this thing actually pushes through here, I suggest to you the top will actually already be in for the stock market. Okay, so we're going to have to watch for the stock market breakdown and failed cycles to occur. And then by the time this shows up, I would take that as confirmation, particularly if it's occurring against a backdrop of high yield credit spiking. And all of this would just make perfect sense given where we are in those major 4-year cycles. For anyone that doesn't know what I'm talking about, I think most people are familiar with Bitcoin's 4-year cycle measured low to low, okay? But a lot of people don't realize that the stock market also has a major 4-year cycle, and gold has an 8-year cycle with a half cycle low due right around the same time as the stock market and Bitcoins. So I make the case that these are all synced up for a reason, along with oil's major cycle low and a Dixie's cycle low getting ready to bottom any day now and reverse, okay, suggesting the Dixie's going to get a big bid to the upside whilst everything else comes tumbling down like a traditional flight to safety trade. And that also further evidences and supports the case for deflation. Okay, if we're going to get deflation, you better expect the Dixie to be bid very, very strongly. Hence why the Dixie bid here, it has been in the pink text the whole time, along with the rest of the expectations for the slightly longer term. As it stands, okay, we probably can still run this thing hot for a little while longer. And that brings me into the TA and the live trades and positions. Of course, that is why we continue to be position long, okay? So we're still long and strong. We're still pushing this thing and still riding the waves, okay? As it continues to show us more and more bullishness, we continue to adjust these to keep us in trend for longer and longer. The Camel indicator has done extremely well at picking the lows here, okay? As you can see, it continues to pick most of the tradable swing lows and allow us to structure our high probability trade setups around those lows. You can see here it is now hunting for another daily cycle low somewhere around the early December timeframe. So expect to find a new daily cycle low in here and expect us to confirm it with a trend line break above the top. Okay, hence the same as these manual count arrows are here too. For gold looks to be putting in a potential lower high with breakdown retest resumption, suggesting we have maybe topped for the weekly cycle. It was a little bit too early to say for sure. Silver on the other hand is looking a much better, isn't it? Looking like maybe we got 1, 2, 3, 4 and then 5 to come and then a bigger correction. I don't know, we'll find out, okay? But we're still having taken off most of the profit from all the crypto stocks and the miners that we accumulated down at these major weekly cycle lows back in January. Once we've taken most of the profit off by now, we still kept a chunk of them so that we could continue to ride this in case they wanted to push. So if we're going to be wrong on the expectation that that is the top, the best way to be wrong is to profit whilst doing it, which is why we kept some of that exposure, especially in things like SILJ. We've got multiple short and long-term account positions stacked on top of each other. So we're going to keep pushing these just for a little while longer because we've got the benefit of being in early here. But it is starting to look more and more convincing to me like that really was the top for the weekly cycle, and thus we're going to have a multi-week correction here. And I think if I was to draw a yellow squiggle, okay, in the bearish case, probably looks something like this: weekly cycle low, big counter trend bounce, and then head down for that 4-year cycle low. And then that would kind of fit as well, just looking at this by my eyeball, get to the middle of next year and deflation sets in, and then the metals will get hit really hard. So all of that would make a lot of sense from here, but it's quite a slow moving market, so I'm in no real rush here with the precious metals. And then of course Bitcoin has undeniably gone a little lower than I was expecting it to. That's okay, right? Sometimes it does this. It did this back here and it's doing it here now again. So we probably have not seen the daily or the weekly cycle low yet, and I say that simply because we're absent of all of the hallmarks that I talked about earlier on, such as the trendline break and the Brexit cross, etc, etc. No swing low pattern visible on the weekly time frame, is there? Right, but we've got a candidate now for the first time in a while. We've got a candidate for a good swing, a good push, and a breakout. And the real question is, how many people are going to puke their position right into the low, just like they did the same thing back here? And I think the problem with a lot of people's kind of knee-jerk reaction here is we still have a trend of higher highs and higher lows on the weekly time frame. So even if this thing goes all the way down to like 78 or 76k, and I don't think it will, but even if it did, that would still be a higher weekly low. Okay, so you'd still be selling despite the thing being in an uptrend. It's just an objective observation of price action. So as bearish as this seems, as bearish as it feels, the cycle system is not telling me to jeet the bags yet and exit all positions. So we're going to keep doing that. We're going to keep trading the system. We're going to keep adding, as I said, in the members section. And again, it still comes back to that same scenario. I've been talking about two scenarios. Either the yellow squiggle is about to happen from here. We're about to rip 94% out of this low and leave everyone sidelined and wondering how on earth that was even possible. Or the other scenario is we should get like a lackluster bounce here to let us out a little higher up than we are now, and then we'll head down for that 4-year cycle low. So I've not really changed at all. I've been saying the same things. It's just we're ever so slightly lower than I was anticipating. I thought we might bottom around 100k, but we're now at 95. So what's a few K amongst friends? And again, remember, if you're upset about that, you can sell, right? You know, you can sell, you can go short, you can go short on leverage. It's entirely up to you. That's your prerogative. That's what makes a market. So I'm your boy Camel. I hope you found value here today. If you want to continue to follow the deep dives with us, then make sure you hit that subscribe button. If you're a level 3 member, look out for the members only video I'm about to post for you guys. And other than that, have a fantastic weekend. All the best from me. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his